following program sponsored by Adams Financial Concepts.
About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and we're going to be talking about money. You know, where did 2015 go? Here we are at the end of the year, and 2015 is about to end. And here we sit at the beginning of 2016. It's been a significant year, quite a year. 2016 is coming up, and I want to talk about my thoughts, my predictions for 2016. Not that it's necessarily making huge changes, but it's good to sit down and reevaluate. And not just at the end of the year, the beginning of a new year, but throughout the year. And I'll be talking more about that. Over the past 5 years, I've been talking about two themes, and it's close to 6 years that I've been talking about two themes. One is I expect the Dow to reach 100,000. I can't say when, but I may get more specific as this year goes on and next year's go on. And about a super cycle that has been running. It's a period of time in which the average world GDP is actually higher. Actually, the period time is higher than the average world GDP. And I believe that we're living in one of those periods of time right now. That theme, and then also, very often we look at periods of time as being a straight line. But I'm not sure that we aren't seeing an exponential growth. And we're at the beginning of an exponential growth. I think we'll see things even move even faster as we go through this whole period of time in this whole super cycle. But I want to focus just on 2016. A very short period of time in the reality of things. 2016, I want to do the projections. This is a follow-on to the program that I did on the 18th of December. I started talking about commodities and oil and gold, wages and inflation. It's a setup to get to where we are today. Today, I'm going to finish that and talk about where I expect the stock market to be, because all those things have an impact on where we are with stocks. But before we get to that, I want to remind you that if you have and are dealing with a lot of data, that one of the people that was on our program was from BrainBox. They actually sort data, manage your data, and put it into a form where you can really understand what you're seeing. You know, you can really get value. You can find them. And they have offered, all you have to do is mention that you heard about them on About Money, and they will give you a complimentary consultation with their founder and CEO, Adam Nathan. You just log on to www.teambrainbox.com. Tell them that you heard about it from Mike Adams on About Money. You'll get a free consultation. It's an excellent thing to do. So this is the time of year when you see on TV, when you see on magazines, when you get newsletters, what is the best mutual fund to buy for 2016? What's the best stocks to buy? Barron's, big article at the beginning of December saying the 10 best stocks to own for 2016. And then they followed a week later saying the 10 best small caps to own for 2016. The stocks to sell, the stocks to buy, the mutual funds to buy, the commodities to buy, the things to sell. You know, there's nothing magical between December 15th and January 15th of a new year. It's an ongoing process. If you really want to do well, you don't come to the end of the year and do a rebalance or a change. You do it throughout the year. But, you know, when you look at what's going on in the media, those are the things which sell magazines, they sell newspapers, and they get you to listen to the programs. That's their agenda. It's not that they want to make you a lot of money. They want to sell advertising. So keep that in mind as we go through this. Don't focus on the short term. Dalbar's done a study where they show that people do so many switches of mutual funds that they make about a third in terms of return of what they could make if they didn't do all the switching. But anyway, that's another thing. I just completed the book not long ago, Super Forecasting by Tetlock. Tetlock gained fame back starting in 1987 by engaging a number of experts to make predictions about the USSR, about Quebec, about any number of things, and he evaluated how well they did in predicting. And then he's come out with his new book called Super Forecasting, talking about how forecasting should be done and that the actual forecast should be numbers. So in the past, my forecasts have been general. I think the market's going to go up. I think it's going to go down. I think this is going to do that. I'm going to try to put it into numbers and give you a quantitative number. But forecasting is not just a one-time deal. If somebody's trying to predict the weather a year from now, they're going to change their mind as we go on. They're trying to predict the weather on January 1st, 2017. They may have some inkling of what the weather might be like looking at the averages. But as it gets closer and closer, they're going to refine that, moving the temperature up or down, moving the moisture up and down. It's the same way in forecasting. I have my thoughts about where we're headed for 2016 and 2017, but it's going to change as we go through the year. Barron's does an article where they talk about the round table, where they forecast what's going on for the year, but at mid-year, they do another analysis. Prediction is the business that we tend to be in. Forecasting is the business that financial advisors tend to be in because we're trying to forecast what's going to make money and what's going to avoid loss. And yet, in many ways, it's a foolhardy venture. 6th century poet and philosopher Lao Tzu said, and I quote, "Those who have knowledge don't predict, and those who predict don't have knowledge." Interesting. Should not be the thing that I'm doing, but that's what I am doing. So maybe I have knowledge, maybe I don't. But we are in the prediction business. You know, the analysts are wrong 94% of the time when they're forecasting 2 years out. They're like the weather forecaster forecasting today what the weather's going to be like on January 1st, 2017. They tend to be wrong 94% of the time. And analysts tend to be wrong on a 12-month forecast 45% of the time. You know, in 2008, at the beginning of the year, analysts in general predicted that stocks were going to be up 24% in 2008. Actually, they were down 37%. So it's a time in which you look forward, you begin to build portfolios, you begin to build your investments, but it's something where you have to evaluate what's going on. When a weather person says there's a 70% chance of rain, that means there's a 30% chance of something else happening. So when we talk about this, the probabilities change, and it's very much like looking at the game of poker. You know, when you look at the stock market and managers in the stock market, it's very much like poker. If you take and compare it to other games, if you compare it to the game of chess, for example, experts always beat novices. They always beat novices. Novices never beat the experts. If you look at slot machines, experts and novices win at the same frequency. There's no difference in slot machines. But in the game of poker, sometimes a novice will draw a hand and beat the expert. But if you're a really good poker player, you understand that probabilities change. You know, for example, I use the game of Texas Hold'em because a lot of people know Texas Hold'em. The basics of the game are that all the players, for example, there might be 6 players at the table. All the players are dealt 2 cards face down. They then evaluate their cards. They can either draw out of the pot, or they may bet. They look at those two cards and they bet. If you want to stay in the pot, you make a bet. Then you're dealt a flop. It comes up 3 cards, and you have to evaluate, and the probabilities change. For example, if you're dealt 2 aces as your bottom cards, that's a very good chance. When you have 6 players with 2 aces, you have about a 50% chance of winning. So you have a good hand. If you have a 10 of spades and a 6 of diamonds, your chances are about 1 in 8 to win. But you know what? When those 3 cards come up, if there's 2 10s and a 6 in those 3 cards, your chances just went way up, and the aces went down. That's evaluating the probabilities. And with poker, it's very much the same as what you have to do. When the 6th card comes up, the turn comes up, the river comes up, it changes all the probabilities, and it changes how you're going to do. So that's why Barron's has a mid-year roundtable. They look at it at the middle of the year, and they make changes in their forecast. As we go through this year, I'll make some changes as well. So we're coming up to a commercial break. Don't go away, because I haven't even gotten into the forecast yet. We've got a lot to talk about. Don't go away. I'll be right back after this commercial break, and we'll begin to talk about what I think about different things.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So remember that TV ad not too long ago? It said gold was going to $5,000 an ounce. Gold at that time was like at $1,500. Gold going to $5,000 an ounce. Was it a good deal? Was it a bad deal? How did you evaluate? You know, with stocks, you can look at them, evaluate by the earnings, revenues. You can look at the products. With bonds, you can look at the underlying credit and know the probability you're going to get your money out. But gold, how do you value? It's this yellow thing that you can hold in your hand or on your ring or whatever. But how do you evaluate? Gold is really an inflation hedge. Long term, it's how you value gold is in terms of inflation. I wear a suit most of the days to work, and in theory, you could say that in gold terms, it would have cost me the same 60 years ago to buy my suit as it does today in gold, or that's the equivalent. So how do you evaluate gold? Here's my thoughts on the whole thing. The dollar was tied to gold back in the 1930s. It was an attempt to stabilize the dollar. Bad attempt. Tying the dollar to the gold standard is a real mistake. But it was tied to the dollar, and it was $32 per ounce. And it continued through the 30s, the 40s, the 50s. And it wasn't until Nixon in 1972 uncoupled gold and the dollar. And gold soared. It soared from 32 to over $800 an ounce. And then it started to fall. But if you look at the rate of inflation from 1933 to the present time, if you had $100 in 1933, when gold was $32 an ounce, that $100, if it was invested in an inflation, just in inflation, that 100 would have grown to $1,792.46. That's an average of 3.58% per year. You know, that's what gold was. And so if you look at gold, is the real value was $32 per ounce, which was a market amount back in 1933. And you look at what gold should be today based on that. Gold in real value should be $573. Gold's selling for $1,000. That means it's selling for significantly more than the increase of inflation. Significantly more. You know, if you look at what's happened when you had gold mining companies, you had them with gold prices going up and up and up. They were opening more and more mines, mining more gold. The cost to lift that gold out of the ground was increasing. They were lifting gold at $800, $900, $1,000 an ounce. There was an excess supply. And what happened is gold companies used to sell forward their production. So if you were a gold mining company, you used to sell gold to be delivered a year from now at a slightly higher price than the current price, maybe 3% higher, equal to about the rate of inflation. But those companies, as gold prices were soaring to new highs, found out they were losing money by selling forward contracts, and so they quit selling forward contracts to sell on a cash basis. Buy the gold today, because tomorrow it's going to be up 15 or 20 or 30%. They quit selling on forward contracts. Now they're beginning to sell on forward contracts, so you have extra sellers coming into the market and the price coming down. So my forecast, I'll give you a number. My forecast is that by the end of next year, gold will be selling for $516 an ounce. Should be selling for $573. That's really close to the actual value, but it will overshoot by at least 10%. And it won't be at the very end. It's going to drop more after that. We'll see. I think it's going to overshoot. I think it's got 50% downside in the price of gold. I've talked about oil, and I want to shift and talk about oil. Talked about oil at the end of 2014 as not being something that was a temporary drop. But there's a book out called The Oil Kings. And that book talked about what happened during the Nixon-Kissinger time in this country. You had Iran, who was, at that time, the country we considered our very best ally in the Middle East. We sent them equipment. We built bases there. We trained people there. The Shah of Iran, our good friend at that time, wanted to rebuild the Persian Empire. And he saw this as a way to do it. And Kissinger and Nixon, in backdoor negotiations, talked about oil because the way that the Shah had to build the military strength. And we saw them as our strongest military ally in the Middle East and a buffer against the USSR. The way he wanted to pay for it was with oil, but he couldn't drill enough oil to meet all of his demands for military equipment. So what he did instead is he wanted to raise the price. And the price didn't start with OPEC. The price started with those backdoor negotiations. We only know this in the recent days because of the Freedom of Information Act, and all this information came out. This was a backdoor negotiation between Nixon and Kissinger and the Shah of Iran. That's how oil got started. That was in the 1970s. Eventually, there was pushback from the U.S. because the Shah wanted to raise prices more and more, and he drew together the OPEC nations, and we all know what happened during the oil crisis of the mid to late 70s. But oil today is one of those products which has been, I believe, the price drop is just the opposite of what happened in the 1970s. You had Russia that invaded and took control of Crimea and then invaded the Ukraine. And they wanted sanctions on Russia. Now, Russia gets one half of their revenues, their government revenues, from oil and gas, and one half from taxes. So to put pressure on Russia, if you really want to put pressure, like Reagan did, you hit them financially by dropping the price of oil. But you've got to also have the Middle East countries to go along with that. And they have an issue with ISIS. ISIS got a lot of their income from selling oil. When they invaded, they got a number of producing oil wells, of refineries. And so if you could reduce the price of oil, it puts a squeeze on ISIS. And that's why the oil-producing nations went along. We gained, Western Europe gained, the Far East gained, a few oil-producing countries lost out in the whole thing, but it put a squeeze on Russia and Iran. So the drop in oil prices started down and came down very rapidly. But that was just the beginning of what happened with commodities, because you had a lot of speculation going on. Remember, in the middle part of the 2000s, we saw the oil price jump to $157. A lot of that was due to speculation. Nobody keeps track of how much was speculation, how much was real. But the estimates were that over half of the forward contracts were speculative contracts, people never intending to take possession of the oil. So when oil prices went down, those prices came down, but they went back up, and you had hedge funds started with commodities. You had financial advisors believing that commodities were another asset class suddenly appeared on the stage. You had mutual funds. You had a lot of commodity asset products formed to do and buy commodities, not just oil, not just gold, but a broad range of commodities. When oil prices started coming down, that put a huge pressure on commodities. Commodities are purchased on a very high margin, and so when one product starts to come down, it can force a lot of sales of other products. And I believe that's what happened. That's where we are in commodities. Add to that the fact that credit was really easy in the 1990s and 2000s, and as people looked at all these contracts that were out to take delivery in the future, they began to build, and you see that. Steel, 600 metric tons per year, excess capacity, 600 million tons. Aluminum, a 23% excess capacity of aluminum over demand. We've seen this in commodities. We've seen a significant amount of commodity overproduction, overcapacity, and it's going to take time to work on. The commodity market is growing at about 3% a year. Take it in aluminum, it'll take 7 years to get back to where we were. We had in the housing market an example of what happens with housing. It took a long time for housing to come around. It took 9 years, and we're still not back to the high prices. That, I believe, is going to happen with commodities. So you have those things setting up for what's happening in the stock market. We're going to come back very shortly and talk about stocks. I have an interview as well to do, so you want to hear that interview as well. This whole thing is setting up for a time and setting up for particular discretion or particular dispersion in the stock market, where certain stocks are going to do well, certain are not going to do well. It's being in the right place at the right time, and that's coming later in the program. So you want to hear what that has to happen. And if you miss any of these programs, you can find them on the website. If you didn't hear the program on December the 18th, tune in to that program and listen, because that's part one of this program. If you didn't hear some of the other programs talking about oil, talking about what's going on in the rest of the world, that's also important. It's a time to look forward to 2016, and it's being in the right place at the right time, because the commodities issue is not going to go away. It's going to take years to resolve itself. And that's going to be something that has an effect on the entire stock market. But at the same time, being in the right place at the right time is going to be very profitable. Don't go away. We're coming to a commercial break. You want to hear my guest because they're coming right after this commercial break. And then I'll talk about stock market and where I see it. You ready?
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
We return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So welcome back, and I'm going to talk about what I expect the stock market to do. But first, I want to introduce my guests for today. They've got a very interesting story. It's a new firm. I think it's going to do very, very well. Troy Hunter and Justin Walsh of the Issaquah Law Group. Welcome to the program, Troy and Justin.
Good morning, Mike.
Yeah, morning, Mike. Thanks for having us.
Actually, it's afternoon, but it just seems like morning, but that's okay. So Troy, why don't we start with your background?
I did a variety of jobs before going back to college. And while I was in college at the University of Washington, one interesting little fact is I worked as a death scene investigator for the Snohomish County Medical Examiner's Office.
That must have been very interesting. A death scene investigator, like CSI.
Like CSI, exactly, but before all the tech toys, really. It was a fascinating job, actually. It was really interesting. And following my undergrad, I also was lucky enough to get into the University of Washington Law School, went to law school there, and then graduated and spent over 15 years as a general business litigator before forming the Issaquah Law Group in June of this year.
Okay. And Justin?
You know, I actually have a very different background from Troy. It doesn't involve any dead bodies, at least none that people know about. Used to work for a Fortune 500 IT company, doing some project management and hardware break fix on some big contracts, and had to make a decision as to what I was going to do next, and decided on law school. So I went to Seattle University School of Law, and from there worked for several years as a plaintiff's personal injury attorney, and then joined up with Troy at our prior law firm and did defense civil litigation on behalf of businesses and personal injury cases on the defense side.
So it seems like litigation is a key part. But let's talk about Issaquah Law Group and what you focus on.
Well, we combined our knowledge and over 25 years of experience and bring that to our clients at Issaquah Law Group to assist businesses and insurance companies in all manner of litigation involving personal injury, property damage arising out of commercial general liability. So that can be premises liability for your premises, your business, employer liability for employment issues, product liability. We're also a member of the Master Builders Association. We represent a lot of construction companies, independent contractors on construction issues. And so it's really a boutique firm. We handle a lot of aspects of litigation for our business and insurance clients.
Yeah, and one of the things we've been able to bring to that too, given our background in litigation, is bring that to the business formation and transaction side of it. We can take those experiences that we've had to litigate and make sure that these businesses don't run into the same roadblocks or pitfalls that we've seen happen in litigation. So it really gives us kind of an edge on the transactional and business formation side of things. You referred to reevaluation, and I think that's one thing that businesses don't do nearly enough. They come to us after the problem's already happened, whereas if you hire someone before to take a look at a contract before it becomes a problem, to take a look at whether your name might result in litigation because someone else already has the name. So reevaluation is key whenever you make a big move with your company.
I would imagine that there's a number of issues with businesses, like business partners, that you've probably seen too.
Yeah, we had a recent case that we litigated involving granola manufacturers.
Not somebody from Oregon.
No, the actual granola recipe that you put in your parfaits in the morning. These two former business partners got back together after they'd split up for a while, and one business partner was having a hard time getting his product out there, so he relied on the other partner to get the product together, get it to market, get it to the clients. But then he stopped paying. And once he stopped paying, the other partner had a decision to make. I have a reputation on the line. I have customers and clients that I'm beholden to. And he decided to keep the business going. And so the former partner sued him for tortious interference of a business expectancy.
And the interesting part of that was there even a business expectancy if he couldn't maintain the business without his friend's help? If you don't pay someone, they're eventually going to walk away. And this is what happened to this guy with several other vendors and suppliers. And this was kind of his last shot. So when our client kept the business going, he wasn't really interfering with anything because there was nothing to interfere with at that point. The second he walked away, the former partner's business was kaput.
So you kept the one partner that you represented in the business.
Correct.
And we never represented the other partner. We all came in after the fact once there was a problem.
So you located in Issaquah. Why Issaquah?
Well, one of the things that we realized in our years of experience is that a lot of the larger firms that are, stationed in downtown Seattle, they have large overheads. They have a lot of office space, they have a lot of staff, they have views of Puget Sound that they have to pay for, and we decided to go to the east side because we could limit our overhead and pass that savings on to our clients in terms of lower hourly rates.
And let's not forget, it's so we don't have to drive Mercer every day.
Okay. As a small boutique firm, I imagine you're very nimble as well.
Very much so. One of the things that we love about having kind of a flexible environment is we have a bit of a choice in what clients we take on. We can kind of help them cradle to the grave, and we can be extremely responsive. Whether it's a midnight phone call needing to respond to some huge issue that's blown up, or a client calling us and saying, "I really apologize, I need this contract reviewed in 24 hours." We have that ability to be responsive where you're not going to go through 12 layers of bureaucracy to get to the people that are actually doing the work.
And how about new businesses that are just starting up?
Yeah, we've been able to start building a clientele in several different areas that are really connected to the Northwest and Washington specifically. The tech industry, the marijuana grow and distribution industry, we've been able to get more clients and cater to those as well.
And one of the nice parts about Issaquah is it is kind of becoming the next area for small tech startups. A lot of these people that used to work at Microsoft and now have places out in Issaquah and Sammamish are often running these new tech startups out of their own home, and this allows them to have a nice, easy connection to the attorney and not have to worry about driving out to Seattle or dealing with kind of some of those exorbitant legal fees that you get from the larger firms.
So you represent small firms, and you also large firms, large litigation?
Yeah, for example, we do businesses and we do startups, but we also represent established businesses. We also represent insurance companies as well. So sometimes we represent a Fortune 500 company that is sued here locally, and we represent them through their insurance company.
So give me an example of.
Well, we represent all the Lowe's stores in the state of Washington for all of their in-store and installed sales liability.
And, an example of some of that litigation that comes around, I mean, we had one client, a local business, and going to let them remain confidential here, but they had hired a contractor to do some text message marketing. And the contractor that they hired represented to them that they know all the laws and here's how you should do this. And with the click of one button, they ended up exposed to $36 million in liability under federal law. And we were able to prevent the business from going under by negotiating it, litigating the case very thoroughly, and get it negotiated down to an amount well under $1 million, let alone $36 million, that allowed the company to stay in business and remain financially solvent.
Seems like you've done a great job for a number of people.
We have a really good track record. I mean, one of the things that we really evaluate cases for, if it's litigation cases, is how strong are the facts and the law. And we have a great record of getting cases dismissed on summary judgment motions. And, you know, that saves our clients money, it saves them time, and it saves them, again, exposure on liability by just early evaluation of the case and getting rid of it as soon as possible.
And also saves them the worry and the stress of going through a lawsuit. That's a lot of what goes on with lawsuits.
It really is, and that's one of the things I always tell our clients whenever they're initially involved in litigation is, you know, we're going to ask you to be truthful, straightforward, and honest with us, but let us take some of that worry off of you. That's our job. That's what we get paid for. And the more we can help our clients, you know, focus on their business, the better off they're going to be in the long term.
Because, you know, it's the old saying that the attorneys make all the money in a lawsuit. And if somebody can prevent going through a lawsuit by employing you beforehand and save all that litigation expense and worry, they can focus really on the business and where they make money.
Well, exactly. I mean, an average lawsuit to take to trial can cost, and we're talking just a general lawsuit here, upwards of $100,000 to take to trial. Whereas if you spend $1,000 getting a contract reviewed, you could avoid it altogether.
Yeah, I mean, our primary goal at the Issaquah Law Group is to minimize our clients' financial exposure to litigation. And we do that in two ways, either through pre-litigation education and training and involvement in the drafting of contracts and policies and procedures, or during litigation by utilizing innovative tactics and strategies to keep those costs down and in the end lower our clients' exposure to a judgment or an award.
So how would somebody get a hold of you?
Well, we have our website. It's issaquahlaw.com. That's ISSAQUAHLAW.com. Or you can give us a call at 425-313-1184.
So thanks, Troy and Justin. I think you're doing a tremendous job just getting started, but you represent a number of clients and have done quite well for those clients. So highly recommend you.
Well, thanks for
Mike.
having us.
We're going to come up in just a short time. I'm going to talk about the stock market and my projection for how stocks will do in 2016. So don't go away. Let's finish it off.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I want to finish up this segment, this time, and finish this 2015, beginning of 2016, talking about the stock market and what I expect for 2016. And I'm going to put numbers to it. I've never put numbers to it before. Today I'm going to put numbers to it. And so Barron's does a roundtable, and they bring in some of the top prognosticators in the industry. And on their roundtable, they were forecasting that earnings for 2016 would be up 5%. General Standard & Poor's 500 companies up 5%. And if you calculate that out, with a price earnings ratio of 15.8 works out to a Standard & Poor's of 2220. So up roughly 5% from where we are today. Going into that, when you look at how the market's going to do, you take all the earnings of the company, because that's really a focus of what happens with companies. As their earnings go up, the stock price should go up. That's just a general rule of thumb. Doesn't always happen, but that's kind of the focus, because if a company's earning more money, it's worth more. It should be worth more, and you should be willing to pay more for the stock. So that's where they are. And that multiple then takes the price of the earnings, and from that calculates the price of stock based on a certain multiple, in this case 15.8. In 2015, the multiple was around 15.7, so they're not making a lot of difference. They're saying earnings up 5% and multiple 15.7. So, for me, that was a starting point. For me, that's a starting point to look at what's going on. But if you look at what's happened in 2015, energy and commodities companies were a big hit. And I don't believe they're going to show a significant change in earnings in 2016. They were a big drag. They're 20% of the market cap, 20% of the Standard & Poor's 500, and yet they represented a drop of 80%. Their earnings were minus 18% for the energy companies. So if you look at the earnings for 2015, they were basically flat to down a little bit. We're going to see some movement upward next year, but it's not going to be by the companies that are doing energy. Now, if you look at price earnings ratios, I want to start there first, because that's a judgmental kind of thing. That's a optimistic or pessimistic kind of thing. That's the perception of the market. Bernard Baruch was paraphrased by Art Cashin, who Art Cashin says, if the market believes that 2 + 2 = 5, they'll pay 4 3/4 for it all day long. My corollary to that is, if they believe that 2 + 2 = 3, what they bought it for, they'll sell at 3 1/4 all day long. So it's a perception market, and that's what the price earnings ratio is all about. It's the perception of how well the market is going to do over the longer term. When you're talking about 15 times earnings, you're not talking about how you expect them to do next year. You're talking about a future time, 4, 5, 10 years out. And if you look at price earnings ratios, back at the beginning of 1981-82, PE ratios, price earnings ratios in January 1st of 1982 were 7.7. Now, the Dow had hit 1,000 in 1966, dropped 20%, then rose to 1,000, then dropped 30%, got back to 1,000, dropped 40%, got back to 1,000, dropped 20%, and finally got back to 1,000 again in 1982, August of 1982. People expected there could be a drop again. Business Week magazine came out saying the death of equities. That was in the end of the 70s, saying that stocks would never rise again. But in August of 82, the Dow hit 1,000 and then went on to 14,000 in March of 2000. We know that. But at the beginning of that time, the price earnings ratio was 7.7. That was a really pessimistic time. People were feeling that stocks were going to be losers for the remainder of their lives. Conversely, if you look at the dot-com time, when everybody was enamored with stocks, I remember I really went negative when I stood in line at the grocery store behind 2 young women, and they were talking, and one young woman said to the other, "You just have to buy stocks. I borrow money on my Visa card, and I'm only paying 18% interest." I mean, I don't know who they were. I don't know what they did. I can't imagine how they felt by the end of 2000, but it probably wasn't feeling very good, having seen their stocks lose money and paying 18% interest on those stocks. But the price earnings ratio at that time, on January 1st, 2000, was 29.04. And January 1st, 1999, 32.92. That's a tremendous optimistic outlook for the stock market. And dead wrong. Dead wrong, of course. We know that now. We know that they were wrong in 1982. They were pessimistic in 2000. They were optimistic. I believe that we probably will be closer to the historical norm of the 15 to 16. So I believe that the Barron's people are right on that. But I talked earlier about commodities and energy in that whole thing. I think those companies have an extended period of time to get through this. We got to see through housing prices what happened with housing. Housing prices hit a peak in 2006 and then proceeded to drop almost 37% by 2010. So there's a period of 3 years. Here we are in 2015. Housing prices have still not recovered 9 years later to what they were in 2006. 9 years, and we haven't recovered completely yet. If commodities, there's an overcapacity, and I've talked about this in previous programs and in this program, there's an overcapacity. Too much credit, too much speculation, people buying forward contracts. Commodity prices, I believe, are going to be down for at least 6 years. On December the 18th, I talked about the impact of the dollar. I talked about how that impacted commodity prices and made commodity pressure even worse. If you look at house prices, they came down in 2010, or they came down actually from 2006 to 2010, and then they bounced at a low level, but they didn't hit the real low until 2012 and start up. I believe that's going to be a similar pattern with commodities. We hit lows and close to the lows this year, and we've got a few years for that to work itself out for capacity pickup. It could be a little faster because home building grows at an average rate of 1.8% per year. Commodities businesses grow at about 3.5%. So that could be a positive. But while interest rates were held at zero during this whole expansion time with housing, or recovery time of housing, we've got the dollar increasing and commodities are purchased in dollars. So the stronger dollar is going to have a negative impact. So my guess is that the PE is going to suffer from that. But at the same time, we're in a very dynamic market, and excluding those companies, we're going to see a Standard & Poor's grow even faster than what they predicted at Barron's. My guess is that we'll see a Standard & Poor's of 2398. It's going to be in selective industries. It's going to be a drag on the commodities and energy businesses, but it's going to be very positive in many of the other areas. That's my projection. It's an ongoing thing. I may revise that up. I may revise that down. I still believe we live in a super cycle that's going to be positive. Commodities are low, but we'll begin to absorb some of that capacity, and it's going to be very good for U.S. companies. That finishes this year. We're at the beginning of 2016. I will be back next Friday. Join me then.
What you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored by Adams